So hello and welcome to the webinar. This is part of the GCV The Next Wave series. My name is Maya Palmer. I'm the editor of Global Corporate Venturing. And today we're going to talk about secondary market transactions for corporate venturers, which has become a very hot topic for our community. A lot of reasons for this. We've obviously seen a huge lengthening of the amount of time that it takes for startups to exit. We've gone from something like 4 years a decade ago to more like 11. So it is natural to want to use a secondary market transaction to capture some liquidity for various reasons. And we've also seen some of the unwinding of the 21 boom in VC, which has made this more prevalent. But at the same time, the secondaries market is changing a little, and it used to be that CVCs, corporates, would often access the secondaries market when they were in something of a distressed situation, wanting to liquidate a portfolio. But actually now we're seeing this become much more of a natural part of the life cycle. But there's still quite a lot of opacity in this market. People don't necessarily know the best methodologies for finding, the right buyers, pricing, and so on. So we have put together a panel today who can really help shed some light on this. I want to introduce this panel, really expert and all with a very different perspective. I will let them introduce themselves in more detail, but I just want to explain sort of why this particular combination is a great one. Because we have Johann Boukhors, Managing Director of ENGIE New Ventures, who has really been very public this year about talking about secondary market strategies, but really needing to be an integral part of the way that a CVC manages its portfolio. It shouldn't be an exceptional thing. It should be part of the bread and butter. Alex Kamenetskiy, Managing Director, COO, CFO at Munich Ventures, similarly uses this as a very normal part of the life cycle management. But I think what's also interesting is that Alex also is on the buy side sometimes of these secondaries where that's appropriate. And then we have two people who really can give us a bit more of an overview of the general market. So Olav Ostin, Managing Partner of TempoCap, has for about a decade, correct me if I'm wrong, Olav, but been, running a specialist fund to look at taking on these CVC secondary holdings. So has seen, really the long run of this, and a little bit more recently set up, but nonetheless interesting, is FreeRun Ventures, run by Davorin Kuchan, who was a CVC himself and therefore thought that, there needed to be a kind of specialist vehicle, which was really looking at the kind of stresses that CVCs face when they are in this situation. So a panel that really can offer us a huge amount of perspective from all sides. I'm going to just make a few, remarks to set up this this session, and at the same time we'd like to run a little bit of a poll to see the nature of the audience, because I think that there's quite a lot of people who are on the CVC side, but also I'm interested whether there are those who may be on the buy side. We'd love to get a sense of kind of where you're coming at this and whether you're already doing secondary transactions, whether you're just thinking about doing it, and so on, because we can then try to tailor our answers to that. So please do take a moment to answer the poll questions. And then the other thing that I would say is that if you have questions, please use the Q&A function, which you'll see at the bottom of your screen, to ask questions. We will try to get to as many of those as we can. So just as we're answering this poll, we've seen this huge jump as in secondary transactions. It was really a primary market liquidity mechanism overtaking IPOs, at least in the US. This is for VCs overall, and this is just in the US, but to some extent CVCs do mirror what happens in that general VC market. And then there was a PitchBook report, again, looking at secondaries usage by VCs overall. And it was quite interesting because they showed sort of some of the biggest sellers in this top 10 list. And what was quite noticeable was that you don't really see CVCs featuring in this much, with the exception of Total Energies Ventures, which of course famously did sell off most of its, well, all of its portfolio as the unit was wound down. And that, I would say, has been probably more of the typical secondaries type of transaction that we've seen in the past, where it was a kind of whole, we're coming out of CVC, we want to we just need to liquidate. But again, I think as the session will sort of show you, that's becoming less of the way that people are using this. So without further ado, I'd kind of like to turn to the session. If I can just ask each of the our lovely panelists to just give us a couple of sentences about, your unit or your fund and how you're using secondaries. And if we keep this really brief, because we can then go into the detail. Why don't I start with you, Alex, and then we can go to Olav, Davorin, and Johann.
Sure. Thank you so much, Maya. Great to be here and talking about this important topic. So, Alex Kamenetskiy with Munich Re Ventures. We're the VC arm of Munich Re, about 1.2 billion AUM, early stage, primarily Series A investors, and just about all of us are located in San Francisco. In terms of our strategy on the secondary side of things, as you mentioned, has very much become a common tool. And in our business, if there's an available tool, why not use it? Especially one that gives this kind of flexibility and agility in terms of being able to execute on strategies. So with that, we really it's not a major part of our strategy, but very much a tool in the toolkit, both on the buy and the sell side of things, and uh, really focusing on working with the portfolio company on this one, or with the founder in terms of the transparency and communication in our intentions, especially on the sell side of things. The preference is always to stay within the cap table as if possible. And so these are conversations we start early on, and we work closely with the portfolio company if there is a sell desire, and working through that. And on the buy side, very opportunistic as well in terms of if there are opportunities within the cap table, or as an access point for us if for some reason we missed the prior round, for us to get early access to set us up for the next round. So we try to be creative with it, and very opportunistic as well.
Okay, great. And then if I can maybe bring you in, Olav, at this point, just to tell us a little bit about TempoCap, and also if you can comment on, are you a huge, huge amount busier than you have been, in previous years, just given how much we're sort of seeing this sort of need for other liquidity mechanisms right now?
Thank you very much. Hello, everybody. My name is Olav Ostin. I'm the founder of TempoCap. I created 9 years ago. We invest mainly in secondary transactions. We do two types of deals. We do single asset secondaries in what we call late stage companies, so companies with more than 10 million of ARR, and either profitable or fully funded to profitability. The average revenue of our businesses is around 40 million last year, growing by 30%. And then the second part of our strategy is to buy entire portfolios of investment from people who are looking to either exit the asset class or generate some DPI to go and do their next fundraise. And this can be any kind of transactions, either a full portfolio or a cherry pick portfolio, or what we call a straight portfolio where we buy half the stakes in the underlying companies. We are based in London. As you can see from my background today, we have an office in Berlin, and we're 12 people. Perhaps one comment on your previous graph, Maya, you said there were not lots of CVCs in your graph. Our experience is CVCs do not want to advertise deals. So each time we've done a transaction with a corporate VC, there's no communication whatsoever. I think the total deal was a bit unusual, But we've done deals in the last few years, obviously, where there's been absolutely no communication. So that might explain also why this graph had a few CVCs. In terms of activity, I would say there was pre-Liberation Day and post-Liberation Day. Pre-Liberation Day, as you explained, there was a lot of factors driving owners of assets, so VCs, CVCs, some hedge funds, to look at doing secondary transactions, and it was already a very active market. And as you said, driven by a lack of exits in general, but also very large, I would say, amount of investments in the period of 2020, 2021. But also in general, there's always a good reason for doing a secondary transaction that might be very specific to a corporate or a VC. We did some kind of CVC deals in 2019, 2020, and 2021 when the market was booming. So there's always kind of some specific situation related to the corporate. And then since Liberation Day, it's just been extraordinary. I mean, the level of interest to get liquidity has just accelerated meaningfully. We see, probably 3-4 portfolios a month at the moment coming through, sometimes more. And it's not because the market's gone down. I mean, it's gone down and then it's gone up. It's just that the level of volatility that this has brought to the market and the uncertainty you get means that if you have a deadline to get cash, and if you expect IPOs or M&A, I'm very happy to see that Klarna finally managed to IPO today successfully. You can get an exit, but there's no certainty. And so looking at the secondary market allows you, if you have the assets to do so, to get some certainty on when you're going to get cash to realize the assets. So I would say at the moment, we've never seen so much activity ever in the last 10 years. And so it's a very, very interesting period, and we believe it's going to continue to be quite an active market.
Yeah. Okay. Well, thanks for that, Olav. So yeah, no, interesting that there might be a lot more happening below the surface that we just don't see. But well, Davorin, I wanted to call on you though, because again, having been a CVC yourself, I mean, you felt that there needed to be sort of almost a specialist fund that would understand the kinds of particular stresses that would be on a corporate in these situations.
Yeah, thank you, Maya. Thank you for a great introduction. Great to be here. My name is Davorin Kuchan. I'm the founding managing partner of FreeRun Ventures. We're a Silicon Valley-based secondary VCP fund. And our focus is to partner with the corporate VCs, with CVCs, to provide liquidity for the investments which may no longer be strategic. As you mentioned, I spent about 15 years as a CVC. I was head of the investments at Texas Instruments many years ago, pioneering a lot of the tenants that we operate with today. I was also head of investments in Hyundai and briefly at LG. So I lived that life for many years, managed over 6 billion AUM. What I found very early on is that when CVCs are very good at making investments and kind of following some of the strategic patterns, but strategies change, market changes, management changes, financials change. And I found it's very difficult in a current setup, in a current marketplace to exit these investments and stay relevant. And I realized that for all of us who operated CVCs, if you're going to be continuously relevant to your parent organization, you have to stay in step with everything that's relevant. And I found the ecosystem around it very, very difficult and nascent. Today, over the last 10 years, the VC market put over 1.7 trillion into the market. A third of it was CVCs, right? And traditionally, if you look at the overall secondary market, 1 to 3% of that goes into the secondary on average. So the current, to give you an idea of the scale, the current VC secondary market is about 138 billion, and equivalent of that CVCs is about 5 billion. So these are all very large numbers, and given the lack of liquidity, that really gets accelerated. So I launched FreeRun to really provide a platform for CVCs to stay relevant and basically exit their investments in an orderly, discreet fashion and really help the CVC with all the challenges that come with the secondary market, because we can talk about it later on in the panel, but secondary can mean a lot of things to a lot of people. And the secondary market is very prolific in the PE stage. Half of the PE companies actually play and exit as secondaries. But on a venture side, and in particular on a CVC side, that's very nascent. So I launched FreeRun, developed a set of platforms to work with the CVCs to educate and help through that process, having experienced those challenges.
Yeah, no, thanks, Davorin. And then last but not least, Johann, I wanted to turn to you, and maybe you can tell us a little bit about the kind of system that you've been creating at ENGIE to really to industrialize this. I mean, exactly what Davorin's been talking about. It's a nascent market. You're one of the people that is trying to make it something that's routine. And I think you also had a sort of thought around exactly this point about ecosystem. There needing to be more of that.
Yes, thank you, Meja, and good morning, everybody, or good afternoon, everybody. First, just an intro about what is ENGIE. As a reminder, it's a global utility leader in the energy transition, about 75 billion euro revenues, a bit less than 100,000 FTEs, and active in about 30 countries. ENGIE New Ventures is a CVC arm of ENGIE that have been running for the past few years, but that was created 11 years ago now. We do invest minority stakes as a usual CVC in early stage startups, kind of 3 to 5 every year worldwide, and in particular with a strategic fit with ENGIE, which is our purpose and added value. Today we have about 30 active portfolio startup running, in which we have invested between 1 and 10 million euro each at inception, and then later we follow. What I'd like to bring here, and it's going to be a bit complementary to what has been said earlier by my colleagues. We see, or I can see, two trends happening at the moment. First, when we started, so 11 years ago, CVCs entered kind of on a passenger seat next to other financial VC funds. But now, due to some changes in the market, in particular liberalization of some markets, that's the case for energy, rise of renewables, etc., that have made this world much more complex than before. And therefore, financial VC see the CVCs, expertise of CVCs, quite useful for them. And we are really appreciated to come at the table next to them in order to provide a market proof, which makes more interesting the portfolios that has been built by CVCs, more interesting than before. And that can explain probably a boom interest for secondaries. On our side, we have also quite a lot refined both our value proposition and our business model to the company, to the corporate. So first, as usual, we cherry pick startups with which an equity investment can provide preferred partnership and create material value to ENGIE every time we measure the impact on the EBIT of the group due to the equity investment. That can be in a form of a competitive advantage, of operational efficiency, market intelligence, this kind of things. That's every time different, but it can be measured. It should be measurable every time as a contribution to EBIT. But then it will help turning the startup scaling up. And then when we deem it ready, we proactively divest in advance of a liquidity event. I insist on that. This is not conjunctural. I heard the liberalization day Olav spoke about, or when the strategy of the group, of the corporate changes. When we set up this practice, if I may say, this was before that. The objective is not to divest or fire sell some useless startup to our corporate, but to have it just usual business. So we have set up some criteria. And we accept the opportunity cost of not staying longer because it allows us to reinject this cash into new startups with higher impact on the EBIT. Because we never have in mind to take control of our startup, and that's really important. Today, this practice, as was said before, is not standard at all, and many think that when we sell, this is doubtful, this can be a fire sale, we want to get rid of the startup, etc. But this is just because we can have a superior return, reinjecting, redeploying this capital in other startups. And that's the whole point. So since we have developed this business model, it has worked and proven its effect, and I'm really convinced it's going to become standard for everybody.
Yeah. So I guess we can pause there, and what I'm going to do is I'm going to share the poll results before we get into this. So what I thought was quite interesting was that about 75% of or more of people on this call, 80% I think actually, if I count all of it, are interested in are either already doing secondary transactions or considering it. So a lot of interest, but not a huge amount on the buy side. I'd say it feels like it's much more on the sell side, and also a lot more are sort of considering it rather than doing it. So I think that gives us a little bit of a cue here for what we can talk about, and so we can dive into a little bit of that. Some of the basic questions, maybe, if this is an audience of a lot of people who are sort of thinking about, okay, is this something that we want to do? I mean, can I sort of start, maybe stay with you for a moment, but then I want to bring everybody in on this. But what about the right time to sell? Johann, because you said you're okay to leave money on the table. You don't have to maximize your return, but what is, though, then the trigger for you to say, okay, well, this is an asset I want to now come out of?
So just to argue a bit, we do have to maximize the return, but the return is at large. It's not only on the equity side, it's also on the EBIT it can create as an impact to the group. And this we consider, and we monitor that. In terms of timings, there are different ways of thinking about it. The first one is to develop a list of startups that we call ready for sale, ready for divestment. And for this, we have a list today. Out of 30 startups, we have 10 on this list. We are not in a hurry. This is not a fire sale. We won't sell it this month, maybe not this year, not all at least. But the point is, what are the criteria that make a startup interesting for an acquirer? We have 4 mainly. The first one is, of course, the impact on the partnership we have with ENGIE, because we intend to keep on working with the startup. This is just that we don't need to block equity in the startup anymore, but the group will still keep on working with the startup. So we should not have an impact on the partnership if we divest. Second is the market traction. As Olav was saying, this is quite important to make it sexy for an acquirer. And basically, is it very close, or has it already gone through breaking even? That's an important point. Third point is about technology de-risking. Growth funds, PE funds, they don't like technology risk, and this is more something for CVCs or early stage VC funds. So basically, we need to be able to demonstrate that a few commercial projects have already been reached, and this has become business as usual, basically. There will be still some development within the startup, but most of the risk has been elapsed already. And the fourth thing that is more, I would say, better or nice to have is there a robust syndicate of co-investors behind? It always makes it nicer. That's easy. And maybe a last point, we notice that it is much easier to do a secondary sale to an external investor during an investment round, during a funding round. At the same time. Why? Because it allows the acquirer at the same time to inject money in a primary round, preferably the last one of the startup before breaking even and at all, so that they can get the best of all worlds. Basically, they have more shares at a lower cost with a better average price in general, and more power, because when we sell, we also transfer our rights. So that's probably the best time or the easiest timing, and moreover, a key advantage doing that way is that the startup is it's the best startup. It's the best time for the startup to pitch. So the job of a startup, the activity of the startup is first not to raise funds, but they have to, but is not to provide liquidity to their investor. They don't care. This is not their activity, their business. But if they have at the same time to raise funds, then this is one effort for two benefits.
Alex, I noticed you nodding vigorously, and Olav, I'll come to you next, but I just wanted to maybe hear from Alex about how you kind of judge that sort of moment to exit, or indeed in fact when you buy on secondaries.
Yeah, I think Johann spot on the timing piece. As we typically try to come in early. So if we've been in there since the Series A and companies getting ready to fundraise the C or the D, this is where conversations start happening. Actually, for us, probably at the prior round, saying, "Hey, we're going to be looking to exit in the next round, so keep us in mind." So all of a sudden, you have the founder that has an extra talking point when he or she is out there fundraising. If there are PE firm or growth stage investors that are looking to hit a certain ownership target, now the founder knows that there are multiple tools in there in terms of, well, I don't want to have this much dilution, but I have a way to get you to this ownership, and with all the other benefits that Johann mentioned in terms of a better average price per share, of course, preferred, all of that, and it really creates a good old win-win-win for the portfolio company, for new investor and earlier investors, in terms of because you also don't want to be taking money off the table, in terms of if it's between injecting new capital into the startup versus you exiting, you don't want to be in a position where you're taking money off the table for the startup either. It really needs to be incremental to for the new investor to hit that ownership threshold. So those conversations are quite important with the portfolio companies in terms of setting up those expectations. And you're not having most of those conversations, but the founder is, and it's really great to have them engaged in that type of way, representing your interests in that way.
And do you have a way of judging when you've got a portfolio company where it's right for you to make that exit?
Of course, similar to what Johann said, in terms of we identify where we have DPI opportunities in terms of our engagement is lower, there are later stage investors that are more engaged in that element. So we're on the cap table. We've done our part. There's an opportunity for us to lock in some DPI, and those are the ones we flag in terms of, okay, let's have a conversation with the founder. Let's test the outside markets to see what the bid and the ask is kind of looking like. And so there's much more activity there as we look for that optimal liquidity moment, without, because if these are typically our better performers, so you don't want to be taking significant discounts as you look at the fund overall. That's too steep of a price to pay sometimes. But similar to what Johan said, we identify those opportunities, and then there's a different strategy involved with those that are flagged.
Yeah. And Olav, thanks for that, Alex. I'm conscious that, Olav, you've been patient, so do jump in. And I also wanted to see if you could maybe comment on what, from the buyer side, you're sort of looking at as a kind of purchase ready company, I suppose, and whether you see sometimes things coming to you that are not necessarily at that stage. So if you had any advice to offer on that side.
Yes, I think first comment on what Johann said on doing a secondary when there's a round. It makes lots of sense on the selling side because there's been a price set on the table by someone. And if you respect this investor that is investing, this investor is expecting to make 3x at least. Nobody invests in this market if they don't expect to make 3x. So you as a secondary investor, you can see, you might not like the way they go about it, but at least there's someone who's saying, I think I'm going to do 3x on this investment. And then if you respect this investor, then it's much easier to kind of pay the same price. Then the question is probably for the seller, if they have kind of share class that are kind of lower in the ranking on the cap table, can they convince the board and the other shareholders to kind of transfer them into the latest class of shares? So if you have ordinary shares, can they all be transferred in D shares? And then, why shouldn't you get the same price? And then if you have alls, then this is a C round or a D round, there's going to be a discount. But I think for a buyer, at least that, someone set a price and they're expecting to do a significant kind of increase in valuation over the coming years. So now if you ask us as buyers what we like to see, I think what we don't like to see is instability in a business. So you can have a good business that has 50 million of revenue growing. But for example, if there is kind of a very big convertible that might be converted at any time, you're buying 10% in this company and you just don't know what it's going to convert into, at what price, if it's unclear what's going to happen. So it's on the cap table, it's quite unnerving to kind of get into a business where there might be some major changes to the cap table. So as a seller, I think you probably, if possible, want to avoid that risk. The other thing is, if the company needs more cash, it's very difficult for us to forecast what would be the valuation of the next round. Will it be successful? And what is, as a board member and very involved with managers, raising today is difficult. So if the CEO is going to spend 6 months, 9 months fundraising, he's not going to run the business the same way if he meets 30 or 40 investors. So at TempoCap, we much prefer investing in a business that's fully funded also because the management team focuses only on one thing, is the business. They don't have to worry about cash or cap table. Of course, if they fail to deliver on their plan, they might have to do it. So that's for us very important, is that's the criteria. But I understand as a CVC, you can't always kind of sell shares in a business that is fully funded. But the closer it is to profitability or fully funded, the easier it is for us to look at the business. And then obviously the maturity of the business counts. Secondary investors are not going to invest for 10 years. I mean, this is not going to happen. I mean, sometimes we arrive on the cap table and people look at us and say, okay, you want to exit tomorrow. And we say, no, actually we don't, because we do the same calculation as you guys, is we try to have a 3x. So actually it's terribly unhelpful if the business is sold 6 months later, because there's no way we're going to make 3x on our investment. So we look at an exit in 3 years, 4 years, 10 years, 5 years, down the line. And we are hoping that everybody's aligned. And so the alignment of shareholders around the cap table is one of the most difficult things to achieve today. Because take this example, a business was worth 1 billion and a very large investor, let's say SoftBank to name no one, put 100 million at 1 billion and they have a 1x liquidation preference. They don't care if the business is sold for 100, 200, 300, 400, 500, 600, 700, 800, 900 or 1 billion. They will always get 100. So, and while the other shareholders between 200 and 600, they make 3 times more. So for us today, when we look at businesses, and all this is beyond the quality of the business, what you're saying, kind of Johann, the quality of kind of the technology being de-risked, some growth, all the obvious thing, because all of you listening to this webinar are aware of that. But the alignment of interest around the cap table is very, very important. And so, if you had a massive run in 21, if you look at a valuation today, you could be paying kind of, I don't know, 50% discount, and still, if the business is sold for double the money, this is a terrible outcome for some shareholders. It's a fantastic outcome for other shareholders. So this is something we spend a lot of time on at the moment.
Okay. No, I mean, I think, fascinating to get that kind of behind the scenes from your side. And Davorin, I wonder if there's anything you'd like to add to that, because, again, as Olav's alluded, sometimes CVCs can't get all of those things aligned. So, I mean, do you have ways in which you can kind of, again, help them get there, or are there things that you just have to say no to?
Yeah, so we're a financial buyer, similar to Olav. So it's all about, in the secondary market, it's all about IRR, right? About 3x in 15 years is 7% IRR. That's not great, right? So a lot of secondaries are very transactional that way. What's important to notice is that most of the CVCs, we find that most of the CVCs typically have low single digits, high single digits, low single digits percentage on the cap table. So these are not controlling interests. They're minority share on the cap table, but they're very important strategically. So when CVCs sell, it's usually signaling something, and that's probably the biggest fear, that when we have these secondary discussions with the startups, with the CEOs, having CVCs join in on a cap table is usually a positive thing, because they signal confidence, market validation, go-to-market validation, and so on, technology validation. And so when CVCs exit, that could have a potentially an opposite effect. So these transactions are very sensitive. I mean, we find ourselves having to do the very gentle, discreet three-way discussions to make sure that we stay in. To Johann's point and Alex's point, selling CVC shares in a round is a very good time, of course, because there's a market validation, pricing validation, and all that. But we typically find companies that are being traded in a growth stage. They can be late stage Series A, early Series B. And that's partially because CVC over the last 10 years have been going earlier and earlier. In 20 years ago, CVC used to buy into the very mature companies, sort of pre-IPO, mezzanine level, very mature companies. Over the last decade or two, CVCs have gone earlier and earlier, and that makes sense because they want to get as early as possible to get strategic value, more learning, and get ahead of the game. The strategy of the CVCs changes every 3 to 4 years. The medium life cycle or corporate executive by Korn Ferry is like 5.3 years. So these changes happen much more frequently. So we see most of the CVCs exit sort of midway through the process, much earlier. So these companies are not late stage mezzanine level companies. They're still growth stage companies with a binary risk. So these discussions are sort of challenging during the rounds because in a booming market, right, when there's a frenzy and there's everybody wants to buy into these companies, it's great. But we find when the capital is scarce, right, the CEOs don't really want people to sell into these rounds because it's almost a zero-sum game, right? They don't want to lose that capital to secondary transactions. We also find the CEOs being somewhat careful that the discounting doesn't become public. So there's a lot of nuances on the secondary market, because if you're buying at X, and there's a secondary frenzy in the background that CVCs are selling at X minus 60%, the CEOs don't like that, right? Because it spooks the rest of the investors, and so we have to be very careful of that. So there's nuances of the secondary market that we've been having to kind of navigate through the process and working very closely and carefully with everybody involved.
Yeah, Johann, I think you wanted to jump in there.
He's smiling.
Indeed, yeah. While I agree with what has been said, of course, I'd like to bring some nuance. One point in particular. When a CVC sells, it is a bad signal. This is a point we have to change. it is not a bad signal to try to be more optimal than what we used to be. That this is just a signal of deploying or redeploying its capital to new innovation, to new priorities, not necessarily because we changed strategy, but also because the strategy we had has already been complied with. When we scout for startup, we have a priority in mind that we comply with. And then later we need to do something else to find the next priorities because everything is changing so quickly. So I agree with you, Davorin. This is seen as a bad signal, but it should not. This is for us, for example, we sell strategic assets as well, with whom ENGIE is working and will keep on working even when we exit. It has just complied with its objective. The equity, we consider the equity investment as a mean, not as an objective. It is a mean to create material impact on the EBIT through the partnership, through preferred relationship, contracts, these kind of things. And when it's played its role, then we need to deploy that elsewhere.
Just to jump in there, Johann, to be fair, I think you are sort of banging the drum for changing this perception. But what we're probably dealing with is a lot of people still having this, and this is where I want to bring in some of the questions, because we're having some great questions. Please do keep submitting them, because I think I would like to turn to those. But there is one about sort of balancing the timing of the exit with keeping everything friendly with the company and the investors, and this is something, and Alex, I'd like to get your perspective on this, but maybe starting with you, Johann. I mean, how have you sort of made the CEOs and the companies feel okay about this, to get them to understand that this is not a lack of confidence signal for them?
So first, when we started this last year, this was really painful. As you can imagine, we got some responses such as, "You abandon us. We are not done yet, and you are abandoning us." So this kind of not with a smile. Huh? So that was really, really painful. Now, I believe most of these have understood that they are much better off having an investor who is here willingly than an investor that is passive because this is not the priority anymore, than an investor that is not going to participate in the next funding round. And this is a catastrophe. Huh? When a CVC does not participate in a funding round, you need to be able to explain that they don't support because they don't like it, maybe because they don't believe in it, etc., etc. So they are much better off getting support from meaningful partners. And we don't speak about, this is just, again, we don't speak about fire sale. When we speak about a discount, we speak about a reasonable discount to the future round, not to the past rounds. I can see plenty of things or figures, but you don't know with what you compare, so you can't deem about the figure. It does not, or it needs to be justified. But in most cases, to be frank, if things sometimes there are some errors. Sometimes we've put one startup on the list and this was not the right time. We agree. But most of the case, I would say 90% of the cases, this is the right time, and the CEO, the management team understands it.
No, that's helpful. And Alex, how do you handle those conversations with the CEOs?
It's a lot of expectation setting, and every CVC is different. And so being clear and transparent about your strategy, your intentions as early as possible, and preventing those surprises, that's the best way to go about it. And in addition to that, there's a big difference between a full exit and a partial sale. You're really minimizing the noise when it's not a full exit. But in our cases, when we've had these later stage opportunities, we're locking in our returns, but we're not fully exiting because we still want to ride in some of the upside. So we're trying to find the right balance in all of this. And consistency in behavior is important. So if you're going to communicate a strategy, if you're going to communicate intentions, then everyone's looking for the actions that follow. And for us as well, in terms of signaling, being very clear in terms of there are activities that Munich Re Ventures does, and then there are activities that Munich Re does in the later stage in terms of where they may come in directly as later stage, larger check corporate investors. Those are very different signals than what the venture arm is doing. And there's an education element within that as well.
And so how do you typically start that conversation? You know, would you signal it really far in advance? And what's the opener? You know, hey, we've been thinking.
It starts very early, well before we invest in terms of and having to institutional VCs don't have to explain how they operate. CVCs do. We have to lay out this is how we work when we make an investment in the Series A. This is how we operate in terms of reserves. And so if everything is going well, you can very much expect us to follow on. But once you get it in the later rounds, it doesn't make sense for a portfolio construction standpoint. So we'll be very opportunistic in those moments. But if we're on the board, if we're coming in, setting those expectations early in terms of how we behave post in investment and where the firewall is between us and the corporate in terms of behavior, investing, there's a big education element on the front end.
Okay, so almost from day one. Now there's a question here about pricing, and I know we've sort of touched on this a little bit, but I wonder whether Olav and Davorin, if I could come to you on this. I mean, do you have any kind of mechanism for finding the appropriate pricing? I know it's kind of every situation will be different, right? But any guidance you can give to people?
So I think pricing is an art. It's not a science, obviously. So the way we do pricing is we look at the asset one by one. So I'm talking about the portfolio here. On the single assets, the same. But so we would look at where is the company going to be in 3, 4, 5 years when it wants to exit. I think there was a question of, friendly and everybody agreeing on exit. Just to explain this, the point here will answer the question. I think before we invest, we try to understand when is kind of the exit time the board has and the investors have. So when you have a secondary investor arriving, he doesn't arrive and say, well, we're going to sell the company tomorrow morning now, or in 1 year. A secondary investor will have 10%. 5%, sometimes on the board, sometimes not on the board. So it's not going to dictate or change anything. So we're very much fitting in to kind of the previous investor, the previous CVC. And so if basically we've heard that the company is planning to exit in 3 years or 4 years, what we'll look at, where's the company going to be in 3 or 4 years, and apply kind of a multiple of ARR or revenues, and look at generating a 3x return. Basically, if we're buying a portfolio and there's some companies exiting much faster, we'll have a lower multiple return on that investment. There's one thing I'd like to say before I forget is when you're a CVC and selling a portfolio, you can sign a deal selling a portfolio of 10 companies in one go, but closing is very, very difficult because you need then to transfer all these assets into an SPV. And then you have some preemption and co-sell. And so I would urge all of you CVCs listening today, and of course, Johann and Alex, to have some clauses when you invest, allowing you to transfer your assets if they are in a portfolio free of preemption of co-sale. This is completely achievable. You can put a clause when you invest saying if ENGIE or if Munich Re wants to sell more than 3 assets in a package, there will be no preemption or co-sale because it's a secondary transaction. Obviously, unless this is to a strategic when kind of the board or kind of some of the investor can block it. And I would say there's a big risk in execution in our deals. And the risk for us is kind of preemption and co-sale. So if we think we're going to be preempted, why would we spend lots of time working on a company and therefore you don't get people interested in buying this share. So on this point, I think there's a lot that could be done to make the market much more fluid in terms of execution. So basically signing and closing happen at the same time instead of kind of 2 months taking place between the two.
And actually, that's a perfect segue to some of these other questions that are coming in about rights, first refusal and so on. So I don't know, Johann, you looking like you want to jump in there.
Yeah, I was actually going in the same direction than Olaf was saying. This is completely true, and we got that in mind too late, in particular for previous companies. There is this question of preemption that needs to be really dealt with at the beginning, at entrance in the shareholder agreement. But this is not the only one. There's a few others that now we write systematically in our new investment about why to share information, for example. If you're not allowed to share information and that just one minor shareholder blocks you, you're just done. You can't do anything. That's a real issue. This is also a case with the class of shares you have. We discussed earlier about waterfalls, liquidation preference, these kind of things. Now we systematically indicate when we enter, and we enter early stage, so this is possible to do that we will get an MFN, so most favored nation clause, that will allow us to get the same rights as the newer investors. This is not the standard today. This is not widespread, but we succeeded in having this. And to be frank, when you think about it, it is rather justified. I mean, basically, you enter early stage with still a lot of risk, kind of a 90% chance of the startup failing before getting to market. And in the end, this money that you have invested early will never get reimbursed, basically. Will never get returned due to the waterfall. So in the end, what it creates is that nobody will invest early stage anymore, and therefore there will never be any late stage startup to invest in. So this is a kind of clauses that are important to think about at the beginning. In addition to what Alex said earlier, it needs to be fully transparent. When you enter, you need to say to everybody, including co-investors, that you're here for a certain amount of time, and when this is not your best fit any longer, you will leave, even before a liquidity event. It needs to be fully transparent.
Yeah, I think the sort of thinking about this from the outset seems to be really crucial. But I wonder whether, Davorin, I can ask you to jump in here. Is there anything that you can advise people to do if these agreements are not in place, right? Like how much are your hands completely tied, or is there something that can still be done?
Yeah, I wanted to echo what Olav was saying. These transactions can be complicated. We usually do strip sales and portfolios. We did 11. I think it's important for CVCs to understand that these transactions can take 6 months, 9 months. We find CVCs come in the middle of a round, there's a pay to play, and they want to sell tomorrow, and they don't realize there's these things take a long time. The due diligence process is long. The documents are not ready. We as buyers, we have to do full due diligence on a company, on the balance sheet, runway, markets, all of that, to be able to price it appropriately. And these documents are sometimes difficult to get. Sometimes corporates don't have, they're very concerned about not sharing the information, indemnification, that kind of stuff. So this process can be very long and arduous. The other thing is, from a buyer's side, there's meaningful cost for every transaction. We estimated at minimum, 5,000 to 10,000 per transaction cost, and that's if you have an in-house counsel. As a buyer, if you get multiple discussions through three-way counsels, this can be a very high cost. So these things, I would advise CVCs, if you're going through the transaction, start early, as Johann and Alex are doing. Set up these things in place and have a proactive discussions, because if you come, when there's a fire sale and there's a panic, you may be surprised how long these things will take and how much effort this is going to be. So start early, build it in, and prepare the data room as soon as possible.
But is there an opportunity to unwind some of these, clauses or, things that may be kind of stopping the transaction? How successful are you at that? Or
we have to go through every corporate document, and not only not only a particular series that we're acquiring, but also the previous series, and also if we're buying into a round, what are the current terms to make sure there's no more senior terms, maybe there's no more aggressive liquidation preferences. So we as buyers have to do very deep due diligence on every single document that is in. So. The amount of effort, we haven't been able to accelerate. We can come to some random price, but you have to be a prudent buyer. I'm sure Olav does the same thing. We have to do very deep due diligence on all of the above. So the more you have ready, the more you can prepare for us, the more we can dig in quickly, the better it is. But we sometimes find, weeks and weeks go by till everybody's assembling information, and so that's the more prepared CVC is, the easier it is.
So it sounds like maybe there's nothing that can be done if you didn't really set up these things correctly, but you can at least get all the paperwork and documentation there so that it's easy to discover, just what you're dealing with. And we are almost coming to a close, but there was an interesting question here, and I'd like to put this one to Olav if I can. But just about will you behave like a primary investor after purchasing a secondary? I mean, it sounded like you do kind of sit on the cap table very much alongside everybody else. But would you, for example, then do a follow-on round and all of those things that a primary investor might do?
Yeah, we're exactly like a primary investor. Sit on the board, reinvest. Exactly. I mean, I would say there's no difference. There's a question of what changed after we arrived. I would say very little. I mean, very, very little. And as Johann said, or Alex said, I can't remember, the added benefit is if we're going to invest 100 in a company, we've probably reserved some capital for follow-on. So very often, actually, CEOs are quite happy to see us arrive because they know that the CVC was tapped out for whatever the reason. And so we arrive, and one of the first questions we get normally is, could you reinvest if there's a need? So a need is not always a bad need. There could be an acquisition. It's quite good to know that the investor might fund this. There could be an acceleration round. And so all this, very often, after a few questions, CEOs are very positive.
Okay, well, I'm afraid, I think we could carry on discussing this for a lot longer. I'm sorry we haven't managed to get through all of the questions, but I hope this has given people a little bit of an insight from both sides on what to expect. So if you are kind of considering embarking into the process, Olav, sorry, do you want to jump in with one more?
I think I saw a question which is very interesting, and we ought to try to answer it. Should you have a broker advisor, or should you do it yourself? I think that's a very, very important question. And what I would say depends on the size of the transaction. If you have a transaction where you think you're going to have, 50 million, 100 million, an advisor might take it, might make the effort to do a proper job because they're going to have a decent fee out of it. If you're selling a portfolio for 20 million, 25 million, 30 million, which is still a decent portfolio, the advisor is going to get very little fees, or very, very little from this transaction. And imagine if there's 4 companies selling for 20 million, the amount of work they have to do. And then there's not lots of buyers. So also it's not like you're selling a company, you're going to call 50 people. In Europe, there are very few people doing portfolios. We think there's 2 or 3. And unless the GP stays in place, and then there's more kind of pure LP secondaries. And in the US, there's probably 10 to 15. So I think it's a difficult one to answer. But for CVC, the real problem, and I really understand that, is you have to explain to your CEO or whoever is kind of senior up in the organization that you've run a process. So it's very, very difficult to just go kind of with bilateral discussions. But it doesn't always make sense to have an advisor.
Yeah. Okay. Well, I think a good point. Okay. Right now, I'm going to say a big thank you to the panel for sharing those thoughts. And then I just have a few sort of final housekeeping points as we bring the webinar to a close. So GCV runs a lot of courses, both live and online. So if this kind of topic about portfolio management, maximizing the value of your CVC is of interest, then definitely have a look at both our live and online programs on that. We also organize a lot of live events, some of which are coming up. We've got quite a busy autumn with events in Brazil, Tokyo, San Francisco, and so on. So if you are interested in coming to have more of this kind of discussion, perhaps more informally in the coffee breaks of our events, that is to be recommended. If you have a moment, we send out an online survey. If you'd like to give us some feedback on the webinar, that will help us make these better and more relevant. If you would like to contact us, here's my details. I'm very happy always to help connect people if you're interested in that, or you have some comments. And then a final plea. We're running our benchmarking survey, which we run every year on canvassing sort of CVCs globally on their strategy and composition. And this is one of the real sort of foundation stones on which we can then kind of give information back to the CVC community on, what's the norm now? What does best practice look like? How are things evolving in terms of people's focus and strategy? And so we'd really appreciate it if you are at a CVC unit, if you could take a moment, use the QR code and complete the survey. We feed that information then back to everyone who takes the survey. So you then get a lovely document that allows you to benchmark the performance of your unit. And secondaries are at least there's a few questions about that. So we may be able to then use that for future coverage of this topic as well. So thank you for all of your attention and great questions. And thank you again, Olav, Alex, Davorin, and Johann for sharing all those thoughts and long experience.